So, welcome back to the deep dive. Today we're basically looking at the death of the human landlord.
Yeah, that's one way to put it.
I mean, it is. We're looking at the rise of this completely autonomous digital workforce. And for you listening right now, we know why you're here. You want to know how to make money while you sleep. The absolute holy grail of passive income.
Right, the dream everyone is chasing.
Exactly.
Yeah.
But the tools to do that have completely mutated over the last few years. So we've got a massive stack of sources today. We're looking at a snapshot of 2026's best dividend tracking tools, some really fascinating insights from a Fidelity Investments discussion on modern yield strategies.
Which is super relevant right now.
Super relevant. We also have this crazy YouTube solopreneur's blueprint for a business run entirely by AI agents, plus a McKinsey report on the macroeconomic impact of automation, an academic paper that literally models the socioeconomic output of AI, and to cap it all off, a really deep case study into the ethical nightmares of Microsoft's Power Platform.
It's a lot to get through, but it all connects.
It does. Because the overarching theme here is this massive transition. We are moving away from passive income, meaning just, owning physical assets or stocks.
Yeah, the traditional stuff.
Right. And we're moving toward deploying independent AI agents. We're going to explore how you can actually leverage these tools, why treating AI as an independent producer just completely breaks and rewires the global economy, and the massive ethical landmines waiting for you if you aren't careful.
Which a lot of companies are stepping on right now.
Absolutely. So, okay, let's unpack this. We are basically looking at the evolution of wealth creation itself. It's going from the slow and steady tortoise of dividends to the hyper-accelerated hare of AI automation.
I like that analogy. And I think before we get to fully autonomous AI businesses, the hare in this scenario, we have to understand the baseline of passive income in 2026. Like, what does it actually mean to make your money work for you today?
Right, because if you don't understand the foundation, the AI stuff just sounds like magic.
Exactly. So if we look at the Fidelity source, they break down traditional wisdom. And the core of passive income used to be really simple. It was either banking, so loaning out your savings for interest, or utilizing an unused asset.
Like renting out a spare bedroom or renting out your car.
Right. And then you have things like REITs, real estate investment trusts. These were actually created back in the 1960s.
Wait, the 60s? I always thought REITs were a newer financial product.
No, they've been around for decades. The whole point was to let regular people own a tiny slice of income-producing real estate. So instead of needing $10 million to buy an entire skyscraper like the Empire State Building, you could just buy a few shares of a REIT that owns it.
Okay, that makes sense. Democratizing commercial real estate.
Exactly. But the key rule with a REIT, the thing that makes them such a staple for passive income, is that legally they must pay out at least 90% of their taxable income to shareholders as dividends.
Wow, 90%. So they basically can't hoard cash.
Right. They pass the income directly to you. And that brings us to dividend stocks in general. But here is the massive danger that Fidelity warns about. And we see retail investors do this all the time, chasing high yield.
The yield trap. Yeah.
The yield trap.
Yeah.
Because people see a 12% yield and think, wow, guaranteed 12% return. But yield is just a ratio. It's the dividend divided by the stock price. So if the company is basically failing and the stock price is plummeting...
The yield mathematically spikes up.
Exactly. You aren't finding a great investment. You're just watching the math disguise a collapsing company, which is why traditional advisors always pointed people toward dividend aristocrats.
Those are the companies that have increased their dividend for, 25 years straight?
25 plus years, yeah. Companies with massive stability. But here is where the Gainify source comes in, and this is where it gets interesting for 2026. Even this old-school, slow-moving dividend investing is getting a massive AI upgrade.
Because doing it manually was a nightmare, right?
Right, it was. Retail investors used to try and track billions of dollars in S&P 500 payouts on spreadsheets. They were reading earnings reports, trying to guess what the board of directors would do. They missed opportunities constantly.
So what do the platforms look like now?
Well, you have a few tiers. You've got Simply Safe Dividends, which is kind of the legacy gold standard. They boast a 97% accuracy rate in predicting dividend cuts before they happen.
97%? That's insanely high.
It is, but it comes with a price tag. It's like $468 a year, and it's mostly focused on U.S. markets. Then you have things like ShareSite, which is amazing for tax reporting and tracking. I think it's like 700,000 global stocks.
Yeah, okay, a bit more global reach.
Yeah. And then DivTracker, which is the budget option at $19.99 a year. But then we have Gainify. And Gainify's edge is that it completely shifts the focus from historical tracking to forward projections.
Forward projection, so it's not just looking in the rearview mirror anymore.
Right. It uses AI analysis to look up to 3 years out, utilizing over 30 different screening parameters, and they charge just $7.99 a month for this.
That's a huge drop in price for that kind of computing power.
It is, and the strategy really changes depending on who the investor is. So, for example, retirees. They need current yield and absolute safety. They don't care about 30 years from now. They need to pay for groceries tomorrow. So they might lean toward the safety scores of a Simply Safe dividends.
Right, preservation of capital.
But then you have the FIRE movement. Financial independence, retire early.
The FIRE people are hardcore about spreadsheets.
They really are.
Okay.
And for them, a tool like Gainify is revolutionary because they need to model 10, 20-year forward projections to find their crossover point, the exact moment their dividend income surpasses their living expenses.
So they use the AI to project out those compound growth curves.
Yes. And then value investors use it differently. They use those 30 parameters to find high-yield stocks that are trading below their intrinsic value, basically asking the AI to spot market overreactions.
Okay, here's where it gets really interesting to me, though. And I want to push back a little on this. Because chasing high dividend yields without looking at the payout ratio, like we said, it's a trap. It's like buying a flashy used car with a failing engine. Sure, it looks great on the lot, but the underlying mechanics are totally unsustainable.
That's a great way to put it.
So my question is, are these AI prediction tools like Gainify, are they actually leveling the playing field against Wall Street? Or are they just giving retail investors faster ways to make really bad bets? Because Wall Street has supercomputers.
That is the big question. I mean, Wall Street is always going to be faster. You're not beating a high-frequency trading firm. But what these AI tools do is they provide a behavioral guardrail. They mathematically show the retail investor the cracked engine block before they buy the car.
So it's less about finding a hidden gem and more about avoiding the landmine.
Exactly. It removes the emotional urge to buy that 12% yield trap because the AI flat out tells you, hey, there's an 85% chance this dividend goes to zero next quarter.
Right. Okay, that makes sense. It's defensive AI. But if dividend investing is essentially renting out your capital, you need a ton of money to make money doing that.
You do. A 4% yield on $1,000 is $40 a year. It's not changing your life.
Right. So the 2026 frontier isn't just about renting out capital. It's about renting out your digital clones. And this is a massive thematic transition. We have to move from the slow, steady 4% annual yields of the stock market to a microeconomy.
The YouTube solopreneur.
Yes. The guy generating $4,200 a month in 90 days. We're looking at the Bergtooth blueprint for passive income. And he's using AI agents to do this.
And this is where we shift from traditional assets to algorithmic assets.
Exactly. So let's break down the 6-step blueprint because it's wild. Step 1 and 2 is all about creation. Normally, a creator guesses what people want, spends months building it, and it flops.
It's a huge risk of time.
Huge risk. But Bergtooth used Claude to research niches. He found this high-demand, low-competition gap for Notion templates aimed at marketing agencies. And the price point was sweet, like $19 to $49.
So he didn't even guess. He had the AI analyze search volume and find the exact product gap.
Right. But then he didn't even build it himself. He had Claude build the dashboards, the databases, the prompt libraries inside Notion. It took 15 minutes. The total time for ideation and creation was under 30 minutes.
Wait, Claude actually coded the relational databases in Notion?
Yes. He just copy-pasted the schema. Claude spit out. Then, steps 3 and 4, storefront and funnel. He sets up a Gumroad storefront, which has 0 monthly fees, so no overhead. And he uses Zapier's new AI agents alongside a Brevo account to automate this 5-day welcome email sequence.
Okay, so up to here, it's a smart workflow, but it's still somewhat standard automation.
But step 5 is the real secret sauce. This is where he sets up the 3 agents. This is the business.
Break down the agents. What are they actually doing?
Okay, so agent 1 is the product creator. Every Sunday, it scans the sales data and customer feedback, and it actually generates new template variations based on what people are asking for.
So the product updates itself autonomously.
Yes. Then agent 2 is the optimizer. It rewrites his email subject lines every single week to try and beat the open rates of the previous week. It's constantly A/B testing.
Continuous optimization.
Exactly. And agent 3 is support. It handles 95% of all his customer service via a knowledge base. It reads the email, checks the docs, and replies.
See, when you look at the bigger picture here, this isn't just a side hustle. This is a fundamental shift in business architecture.
How so?
Well, think about a traditional business. You have a product team, a marketing team, and a support team. This solopreneur has replaced human freelancers and employees with continuous automated optimization loops. The asset he owns isn't real estate. It's not a dividend stock. It's a self-improving digital system.
Okay, but wait. If anyone listening to us right now can spin up this exact business in a weekend using Claude and Zapier, doesn't the market instantly flood with identical AI junk?
That is the logical next question.
Right, because where is the actual defensible value for the listener? If the barrier to entry is 30 minutes, supply goes to infinity and price goes to zero.
That would be true if the product was the only thing of value. But the product, the Notion template, is just the entry point. The actual defensible competitive moat is those optimization agents.
The agents are the moat.
Yes. Let's say I copy BergTube's template exactly today. I start selling it. I am starting at day 0 of marketing data. His agent 2, the optimizer, has been running thousands of multivariate tests on email subject lines, pricing elasticity, and conversion triggers for months.
Oh, I see.
His system knows exactly what semantic phrasing gets a marketing agency owner to click buy at 2 p.m. on a Tuesday. I don't have that data. His AI system has learned the specific terrain of his market. That optimization loop is the true asset.
That is fascinating. So the intelligence the system gathers is the real estate.
Exactly.
Okay, so if one guy on YouTube can run 3 agents to make a living, what happens when corporations deploy millions of them? We have to transition here from the micro business to the macroeconomic models.
Right, from BergTube to the ARC's 5th paper.
Yeah, the mathematical proof of AI as independent producers. This paper is dense, but it outlines 5 socioeconomic models of AI agents. And it blew my mind.
It's a great paper. Models 1 and 2 are basically about collaboration. Model 1 is pure human effort. It's the baseline of the economy before AI. You only have human labor and traditional capital. Model 2 introduces AI, but as a collaborator, it's an assistant.
The Gainify tool we talked about.
Exactly, and they model this by sharing resources based on an S-curve or a logistic curve of technological growth. The adoption starts slow, accelerates rapidly, and then levels off. But even just as an assistant over 20 years, Model 2 boosts total social economic output by 23.4%.
23.4% is a massive boost to global GDP just from giving people better digital assistance.
It is, and the paper actually highlights specific math for this. They found the absolute optimal resource split in Model 2. To get that max output, a society or a company should allocate 76% of resources to humans and 24% to AI agents.
So 76% human, 24% AI. That's the golden ratio for the assistant model.
Yes. But then they push the theory further. Models 3, 4, and 5. This is where AI is no longer an assistant. It becomes an independent producer.
The autonomous agents like BergTube set up.
Precisely. Model 4 treats AI as entirely independent economic actors. And Models 3 and 5 introduce Metcalfe's law into the equation.
Metcalfe's law, that's the network effects one.
Right. It states that the value of a network grows quadratically based on the number of connected nodes. Think about telephones. 1 telephone is useless, 2 is okay. 1 billion telephones changes the world.
The value squares itself.
Exactly. So the massive paradigm shift here is that when we treat AI as an independent economic actor Model 4 rather than just a human tool Model 2, the economic output shows explosive, accelerating growth. It stops being linear.
It goes exponential.
And when those independent agents communicate with each other, which is Model 5 society experiences massive increasing returns to scale, they instantly share optimization data across the entire global network.
So what does this all actually mean in practical terms? It sounds like Model 2 is basically just buying a faster horse.
Right.
When you get there faster, but it's the same mode of transport.
It's a good analogy.
But Model 4 is inventing the automobile. Suddenly, the machine is doing the heavy lifting autonomously.
And Model 5.
Model 5, that's connecting all the self-driving cars to a central traffic grid so they instantly share rate data. If one car hits a pothole, every other car in the world instantly updates its route to avoid it. It completely changes the speed limit of the economy.
That is exactly what the math is showing, an interconnected hive mind of economic production.
Okay, but Model 5 looks phenomenal on an academic graph. Massive social output, endless passive income, no traffic jams. But what happens when independent AI producers actually hit the real world?
It gets messy. Fast.
Really fast. Which brings us to the ethical minefield of scaling autonomous automation. Because the real world isn't a clean math equation.
No, it is full of biased data, legal regulations, and human error.
Let's dive into the International Journal of Science and Research Archive. They did these case studies specifically regarding the Microsoft Power Platform.
Which is basically the enterprise version of the tools we've been talking about. It has Power Automate, Power Apps, Power BI, and Power Virtual Agents. It's what massive corporations use to build these AI networks.
Exactly. And the journal outlines 3 specific cases where this went terribly wrong. Case 1 was all about bias in hiring.
This is a classic but terrifying example.
A multinational corp used Power Apps and AI Builder to automatically screen resumes and rank candidates. They thought, hey, human recruiters are biased. Let's let the math decide.
And what happened?
The AI systematically rejected female and minority candidates.
Right, because the AI learned from historical data.
Exactly. It wasn't programmed to be biased. It just looked at the last 10 years of hiring data, saw who was successful at the company, which historically was mostly white men, and optimized for that pattern.
So to mitigate that, you can't just unleash the algorithm. You require intensely diverse data curation and mandatory human oversight.
But, okay, let's unpack this hiring bias case for a second. It seems to me we are kind of punishing the AI for human flaws.
How do you mean?
Well, the AI didn't invent discrimination, right? It just held up a mirror to the company's biased past. Isn't the real problem our historical data, not the algorithm itself?
Yes and no. The data is definitely the root cause, but the algorithm is the accelerant. A biased human recruiter can only screen maybe 50 resumes a day. An algorithm can mathematically enforce that bias across 50,000 resumes in a second, completely standardizing the discrimination as corporate policy.
Wow. Yeah, the scale is the danger.
It is. And the AI is a black box, which makes it incredibly hard to audit, which leads perfectly into case 2.
Right, case 2. The black box of finance. So a financial firm used Power BI to automate loan approvals. Again, seeking efficiency.
And it was efficient.
Way too efficient. Applicants were getting denied loans, but the system couldn't explain why. It was just a black box neural net outputting a no.
And in finance, that is highly illegal.
Yeah, fair lending laws dictate you have to provide an adverse action notice. You have to tell the person why they were denied. If you don't, you risk massive legal violations.
So how did they fix a black box? Because usually you can't just peer inside a deep neural net.
They had to implement XAI, explainable AI. Specifically, they used models like SAP Shapely Additive Explanations and LIME.
Great. For the listener who isn't a data scientist, explain SAP because it's a brilliant workaround.
So it's actually based on cooperative game theory. Imagine you have a team of players and they win a game. SAP calculates exactly how much each individual player contributed to the final score.
So in a loan application, the players are the data points.
Exactly. Credit score is a player. Income is a player. Zip code is a player. SHAP runs the data thousands of times and isolates the exact mathematical weight of each feature. So instead of a black box, the loan officer gets a report saying, denied. Credit score contributed 60% to the denial. Recent missed payments contributed 30%.
It reveals the AI's logic. It forces the system to show its work.
Yes, which saves them from legal disaster.
Yeah.
And then there's case 3, data privacy.
This one is my favorite because it's so easy to overlook until it blows up in your face.
It really is. A retail company built a chatbot using Power Virtual Agents. It was supposed to help with returns, but it's designed to learn continuously from user conversations.
Which sounds like a great idea. It gets smarter the more it talks.
Right, until it starts leaking sensitive personal info. It learned a user's address from a previous chat and then accidentally spit that address out to a completely different user in a new chat.
Massive GDPR and CCPA violation.
Huge. The fix involved differential privacy, which injects mathematical noise into the data so you can't identify individuals, and strict data minimization, basically giving the AI amnesia so it deletes data after set period.
The overarching lesson here is that AI doesn't have an innate moral compass. It just optimizes for the data it's fed. The danger of these black box algorithms is that they destroy user trust and legal compliance instantly. Organizations must establish AI ethics boards and privacy by design just to survive this era.
It's not optional anymore. It's structural. So with AI capable of all this independent production, but carrying these massive ethical risks, where do humans actually fit in?
That is the ultimate question.
Are we just entirely replaced by Bergtube's 3 agents? We have to look to the McKinsey report for the human element here. This is the 2055 horizon.
And McKinsey brings some much-needed hard data to the automation panic.
They really do. Let's break down their data. They state that 50% of all work activities globally representing almost $15 trillion in wages could be automated using currently demonstrated tech.
50%. That's a staggering number.
In the U.S. alone, 51% of activities are susceptible, mostly highly structured physical work and data processing.
But we have to clarify a major misconception here, otherwise people will misinterpret this entirely.
Right. Less than 5% of occupations are fully automatable. We are automating tasks, not entire jobs.
That distinction is everything. Your job is a bundle of tasks. If you're a lawyer, document review is a task that gets automated. Arguing in front of a jury is a task that remains human.
Exactly. So the timeline scenario suggests half of today's work activities will be automated by around 2055, though they note it could swing 20 years earlier or later depending on tech cost, regulations, and social acceptance. We can't just retire and let the agents run the world. Augmented intelligence. Okay, so think about it like this. If 50% of my daily activities are automated, I don't lose half my job. I get half my day back.
Exactly.
I get that time back to focus on complex human problems, strategy, empathy, relationship building. It's like a master chef finally getting a food processor instead of chopping vegetables by hand for 4 hours.
They don't.
Right. They don't get fired. They just invent better recipes because they aren't bogged down in the prep work. Which perfectly sums up this whole journey today.
Yeah.
I mean, we started with the slow, steady world of traditional dividend tracking in REITs and how Gainify is predicting yields. Yeah, Bergtube and his 3 agents.
Yeah.
Then we modeled the massive economic potential of independent AI networks with Metcalfe's law. Exactly.
Yeah.
We explored the severe ethical pitfalls of biased hiring and opaque algorithms with the Power Platform case studies. And finally, we looked at our future working alongside these tools up to 2055, becoming citizen developers. It really is. And I want to leave you, the listener, with one final provocative thought to mull over. If the academic models are right, and AI agents acting as independent producers create explosive wealth through network effects, and traditional passive income relies on owning capital, like real estate or stocks.
Right.
Will the future of wealth inequality be decided not by how much money you invest, but by how many independent AI nodes you legally own and deploy into the global network? It is. Thank you for joining us on this deep dive. Keep questioning the world around you, and we'll see you next time.